The government has again just bailed out SVB and Signature banks, in the way telling all the bank the government is going to provide blanket bailout for all banks. Following our top 10 key problems of a blanket bailout. Moral hazard. The biggest argument against a blanket bailout of all banks is the moral hazard it creates. If banks know that the government will always bail them out, they are more likely to take excessive risks and engage in risky behavior that could lead to another financial crisis in the future. Market distortion. Guaranteeing all deposits and loans would distort market forces by removing the risk element of banking. If all banks are guaranteed to succeed regardless of their performance, there will be no incentive for them to innovate or improve their services. Banks that take risks and innovate should be rewarded with better profits, and those that don't should fail. Unfair to taxpayers. A blanket bailout of all banks and guaranteeing all deposits and loans would be unfair to taxpayers, who would bear the cost of the bailout. It is not fair that those who take risks and make poor investment decisions should be bailed out by taxpayers, who are responsible and prudent with their finances. Large banks are not too big to fail. The argument that large banks are too big to fail is flawed. If a bank is deemed too big to fail, it means that it is so large that its failure would have significant economic consequences. However, this argument ignores the fact that the market would still be able to absorb the impact of a large bank's failure. Smaller banks would be able to pick up the slack, and new players would enter the market. It rewards failure. A blanket bailout of all banks would reward failure and punish success. Banks that took unnecessary risks and made poor investment decisions would be bailed out, while responsible banks that were cautious with their investments would be punished. It sets a bad precedent. If the government bails out all banks, guarantees all deposits and loans, it sets a dangerous precedent for the future. Banks would assume that the government would bail them out no matter what, which would encourage them to take even more risks. Encourages bad behavior. Banks that receive government bailouts may be encouraged to engage in bad behavior, knowing that the government will always be there to bail them out. This could lead to a culture of irresponsibility in the banking sector, which could have disastrous consequences. Misallocation of resources. A blanket bailout of all banks would result in a misallocation of resources. Banks that are not profitable or sustainable would receive funds that could be better used elsewhere, such as supporting new, innovative startups or investing in infrastructure. It's not necessary. Not all banks need to be bailed out. Many banks are financially stable and can withstand economic shocks. Bailing out all banks would be a waste of resources that could be better used to help struggling individuals or small businesses. Government interference. Bailing out all banks. Guaranteeing all deposits and loans would represent a significant expansion of government intervention into the economy. This would be contrary to the principles of a free market economy and could lead to unintended consequences, such as inflation or increased government debt. In conclusion, a blanket bailout of all banks, guaranteeing all deposits and loans across the board would create moral hazard, distort market forces, be unfair to taxpayers, and reward failure. It would also set a bad precedent, encourage bad behavior, result in a misallocation of resources, and represent a significant expansion of government interference into the economy. Now, the banks have no worries about loan quality, who they lend the money to, no concern for risk management, etc., as they know the Fed will take care of everything when they fail. Essentially, all the banks have become public utilities. Nevertheless, many depositors could still feel uneasy and vote with their feet, moving their deposits from the small banks to the big ones, causing more collapses and bailouts.
How is Fed going to manage every bank in the country, branches overseas, subsidiaries, etc., when the bank executives are sitting on their hands waiting for the sugar to hit the fan, and be bailed out.
From economic perspectives, bailouts require new finance facilities, meaning more QE, printing more money, which will fuel inflation even higher, against the plan of quantitative tightening. So the Fed have to continue to raise interest rate even higher, borrowing even more. Lifting interest rates would collapse the bond market, causing problems to IRAs and pension plans, and more mortgage and corporate failures, more bank failures, more bailouts, more money printing. It will be a vicious cycle. When and how is the cycle going to end? If you like the content of this video, please like, share and subscribe clicking the bell. Thanks for watching.